Why are cash flow and credit management vital in financial planning? Welcome back to Plan Future AI Insight. I am your investment Dada, and today we are looking at the fundamental plumbing of your financial house, something that most people completely overlook. We are talking about why cash flow and credit management are absolutely vital in your financial planning. That is such an important question, and I'm genuinely glad you are asking it. Most people jump straight to which fund gives the best return, but without managing cash flow and credit, even the best investment strategy can fail. Let's break this down simply, like we are sitting across from each other enjoying a hot cup of chai. Bar graph: why cash flow is the lifeline. Think of your finances like your household's kitchen ration. Every month, ingredients come in and go out. If you don't track what's coming and going, one day you'll open the fridge and find it completely empty, with no money left to refill it. Cash flow management is simply tracking your income versus your expenses so you always know exactly how much you can save, invest, and spend without stress. Here is why it is non-negotiable. It prevents the leaky bucket problem. Experience shows that 80% of people can boost their savings by 15 to 20% just by identifying unnecessary expenses, like unused subscriptions or daily impulsive spendings that easily add up to thousands each month. That is money that could be building wealth instead of disappearing into thin air. It powers your SIP engine. SIPs are your wealth building engine, but they only work if your cash flow is positive. A 10,000 rupee monthly SIP at a 12% average annual return over 20 years grows to over 1.5 crore. But that only works if you actually have 10,000 rupees left each month after expenses. It funds your emergency buffer. Without cash flow discipline, an emergency buffer never gets built. As a result, a sudden medical bill or job loss forces you to sell your mutual funds at the worst possible time, locking in unwanted losses. Shield: why credit management is your shield. Now, let's talk about credit. Credit is like fire, it can cook your meal, or it can burn your house down. The key is strict management. First, a good credit score saves you lakhs. A CIBIL score above 750, which is the sweet spot for most Indian banks, can get you a home loan at a much lower interest rate. For instance, on a 50 lakh home loan over 20 years, securing a lower rate due to a great credit score can save you over 15 lakh rupees in total interest. That isn't pocket change, that is a child's entire higher education fund. Second, credit card interest rates of 36 to 48% per year are absolute wealth destroyers. Rotating balances on a credit card drags down your financial health, consuming money that could have easily been channeled into a wealth-generating SIP. Magnifying glass: the connection. Cash flow to wealth. The secret sauce most people miss is how these connect. It isn't just about income and expenses. The true cycle is, cash flow discipline leads to a good credit score, which brings lower borrowing costs, leaving more money for investment, which ultimately creates wealth. I've seen families earning 2 lakh rupees a month have nothing to show for it after 10 years, while families earning much less build a multi-crore retirement corpus. The difference isn't luck. It's just cash flow discipline and smart credit management. Rocket DADA's action plan for you. Here is your starter plan for this week. Step 1. Track every single rupee you spend for one full month. Categorize them into needs, wants, and savings. Aim to move at least 20% of your income straight to savings. Step 2. Check your free CIBIL score. Target a score of 750 or above. If it's below that, check for missed payments and clear any outstanding dues immediately. Step 3. Set up a small, automated monthly SIP to establish the cash flow to investment habit. You can always increase the amount later. Glowing star Dada wisdom of the day. Greater than: wealth is not built by how much you earn, it's built by how much you keep. Cash flow is the guardian of your savings, and credit is the gatekeeper of your opportunities. Master both, and money will naturally find its way to you. Your question shows you're thinking at a level most people never reach. Building this foundation now means you'll never have to say, "I wish I had started earlier." Please remember, investment in the equity market is subject to market risk, and it is always wise to consult a registered financial professional. This is Investment Dada, signing off. Stay wise, stay disciplined, and build your future with confidence. Thanks and regards, Kaustav Bishwas from Plan Future. Please visit our website at www.planfuture.in for your data-driven financial analysis. Folded hands.